It's also called ETA, entrepreneurship through acquisition, ETA. And this is a way for someone to be entrepreneurial by buying a small business and then running it. These kinds of businesses are what I call the good, boring businesses. 35% net return for 40 years. They're still higher than private equity. They're still higher than the stock market.
With over 30 years in the investment world, Jon Staenberg has made more than 350 angel investments and managed portfolios exceeding $400 million. He is the founder of Agate Hound Fund, the world's first fund of funds investing in search funds, which are investment vehicles where an entrepreneur raises capital from investors to find, acquire, and operate small and medium companies.
Phase one, you got to raise the money from a set of investors. You got to convince them you're that person who can do this. And you raise enough to pay yourself a little bit so that for up to 2 years, you can go out into the world and find the company you're going to buy. And that's hard. We're going to have something like 200 in our portfolio, 200. We're buying companies that are in fragmented industries, that are growing, that are about 2 to 5 in EBITDA, that don't have a lot of government regulation risk, that don't have a lot of customer concentration risk.
Hi, John. How you doing?
I'm doing fantastic. How are you?
Very good, thank you. I'm very glad to have you here.
Molto bene, right?
Again?
Molto bene.
Molto bene, molto bene. Indeed. Everything good. Thanks a lot for joining us today, John. So I'm really looking forward to the conversation, to dig into your activity, the fund that you're running, and all the details about the specific assets class that you're investing in. And before starting, John, I would like to have a first understanding in terms of motivation for you, because you have been a VC in the past. Now you are into search fund investment, running this fund of funds. Tell us maybe what drives you as a leader and keeps you motivated in the first place.
Motivation is such an interesting question. A lot of my friends are getting to the age where we could retire, where traditionally people retired. But I kind of drink the Kool-Aid from the Warren Buffett school, who is 94 years old. And he skips to work every day because he loves what he's doing. And I'm lucky enough to have found something that I love doing. And so I can't see myself, as long as I'm able, I can't see myself retiring anytime soon, because I have found what I love to do. And I love working with entrepreneurs. I love seeing positive momentum. I like mentoring, coaching. I like the world of capitalism. I like the world of innovation. I feel like I'm learning every day. So I just feel very lucky that I get to do something I truly love doing. And so that's what motivates me. I guess maybe I could say it the other way, which is I'm not a golfer, so I'm not going to go work on my golf game. I might work on my paddle game. I know in Spain that's a big thing, or pickleball here, but that still leaves me lots of time to work on search funds and entrepreneurship through acquisition. So that's why I'm excited about what I'm doing, and it's fun to talk about it with others. Also, I'm motivated because I think I'm in a category where if we do it really well, we're going to help the world. And the world is a confusing place right now. And I think capitalism, when it's really good, can be a really strong agent of change. And it helps people who work hard and play by the rules to get ahead and feel like they're making a difference and they're providing for their family and their friends and for others. And so that also motivates me.
Perfect. Thanks for sharing, John. And now let's dig into the specific assets class that you are dealing with. And you are the CEO of Agate Hound, which is a fund of funds investing in search funds. So first of all, tell us, what is a search fund in the first place?
Oh, I get to do this so many times a day, every day of the week, because search funds are a confusing name, first of all, and I'll explain that. And search funds are having a moment, and I'll explain that. People sometimes even think they know what search funds are, but they don't. So that's the setup. So I am the founder of the first fund of funds for search funds called Agate Hound Fund. And what we do is we invest in a small set of the best institutional funds investing into what I'm going to call searchers. So it's also called ETA, entrepreneurship through acquisition, ETA. And this is a way for someone to be entrepreneurial by buying a small business and then running it. These kinds of businesses are what I call the good, boring businesses. And they're very broad. So what do I mean by that? It could be anything in your city or town that is a required business that every town has. And that could be a plumber. That could be an HVAC company. That could be a dental clinic. That could be a street cleaner, and on and on. And so all those businesses out there that we need from periodically are the kinds of businesses that we target with the searchers to go and buy and then support them as they grow the company. Now, why is it called a search fund? Because the way this playbook or the way that this system, and it really is a system, is set up, is it is taught at the best business schools. Originally, it was taught at Stanford and Harvard. Well, I'm wearing the Stanford hat. And at the business school. So you're essentially saying to a 32, 33, 34-year-old who's probably never run a business before, but because they got into one of these very good schools, they're saying, you're smart, you're hungry, you can figure things out. Do you want to do what it takes to be an entrepreneur through buying a company? And they take them, it's a class. It's a detailed class. And there's 3 phases of a search. Phase 1, you got to raise the money from a set of investors. You got to convince them you're that person who can do this. And you raise enough to pay yourself a little bit so that for up to 2 years, you can go out into the world and find the company you're going to buy. And that's hard. You're on the phone, you're emailing, you're reaching out, you're going to trade shows, but it's mostly no, 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 and no. And then every once in a while, someone says, yes, I'm interested in buying and selling. Sorry. I'm interested in selling my company. But then there's a negotiation. There's the NA of that transaction. That's also hard. And so let's say you get through all that, then you've got to actually run the company. And that's hard. So this is not a path for someone who wants it easy, for someone who wants to go to a venture-backed startup and ride along, hoping that it becomes a unicorn and then get their stock options valued for a bunch of money. That's another way to be an entrepreneurial, but it's not this way. This way is the gritty, climb that mountain, do whatever it takes kind of entrepreneurship that is what small business, middle America certainly is all about. So just to give you a sense, Stanford, Harvard, and there's Booth and Wharton and Northwestern. And in Europe, where you are, there's IA, and ISA, and London Business School, and INSEAD. Very few, something like 1% of all the students who take this class decide to do this. Because ultimately they go, that's not something I want to do or take on. It takes a certain type of person. And so the people then say, I'm going to do this, raise this fund. It's not really a fund. It's just a pool of money for the search process. But what's beautiful about that is they have, and you have a company called ICEO Technologies, where you help venture-backed companies by placing really good mentors and coaches and business people into those companies. In search, it's built in because I'm raising money from these 10 to 12 investors who have literally collectively 200 years of actual experience of searching, buying, running, and successfully exiting a company. So they're like a YPO form. They're like a coaching staff for the entrepreneur. And that is part of the magic. That is part of the success formula. And you know it because you do this in your day-to-day job. But we're applying it to where it traditionally has not been applied. And so we're trying to take these small, good, boring businesses and applying best practices to them and growing them such that they're ready for private equity to buy them. So we are doing something in an area where most private equity doesn't want to play. It's too small. And because of that, we get to buy them at a price that is lower because it reflects kind of the messiness. But with this playbook, we're able to take it to the point where we get to sell it all dressed up, cleaned up, better operating, better margins, growing faster, et cetera, et cetera. And we get to sell it at a multiple arbitrage because we bought it, say, at X EBITDA multiple, and now we get to sell it for 10X EBITDA multiple because it's worth more at that point. You know, it's like taking an apartment building and you buy it and you see that the paint has been neglected or that the landscaping hasn't been well taken care of or the management is just not very nice to the tenants. And you buy it, it's making some money, and you buy it and you start, oh, we're going to paint this, we're going to clean up the kitchen, we're going to be nicer, and now I can raise the rents a little. Guess what? It's more valuable. And that's what we're doing with small businesses, if that makes sense.
Perfect. That's great. That's very, very much clear, John. Tell us maybe, because you come from the venture capital world, and you've been also been investing in hundreds of companies as an angel. Why did you choose to move from VC to the search fund in the first place?
Well, I think there are two main reasons. For me, when I started venture a long time ago, venture capital was so exciting to me at the time. And it wasn't mainstream. It wasn't what everybody already knew about. It was something like search funds I had to describe and explain. And even my mother, why would you invest in something that's probably going to go to zero, right? And really, that was most people. That wasn't just my mom. And it was confusing. But when you understood that you could get one or two outsized returns to make up for all your mistakes, how exciting. And how exciting to be on the leading edge of innovation. And how exciting to be where entrepreneurship was about changing the world. And that's what it was when I got in. But another reason I got in is because I knew, and this is how I approach anything I do, I knew what my value add was. I knew what my differentiation was. At the time, I had been working at Microsoft, and people cared in the startup world back then, less so recently, but they cared, how are we going to compete with Microsoft, or how are we going to partner with Microsoft? And so I was a guy that said, hey, I want to be in your best deals. I don't need to take very much. I'm a smaller fund, but I will be the guy that will help you interface and connect with Microsoft and navigate that relationship. So I was very clear about what I could do for my differentiation and add and value add. Today, I don't know how to do it. Today, it's very noisy. Today, it's moving very fast. Today, I don't have that edge. And so I said to myself, this is not the game for me anymore. Sometimes you got to know when to hold them, and sometimes you got to know when to fold them, like the song says. But I wasn't done working. And again, I refer back to Warren Buffett, and I thought, where can I get the kind of returns for myself? Actually, I was thinking for my own portfolio, given the craziness in the world. I mean, I just look at the world today and I say, you know, real estate had this amazing run. Is real estate going to have the same run? I don't know. You could argue no. The stock market. What a interesting 7 years or so in the stock. Is it going to continue in double-digit growth? I don't know, right? Name any category. And then I looked back at search funds, which anybody here listening today, there's a really good study by Stanford, the Stanford Search Fund Study. You can search that, and no pun intended. And it gives you a 40-year analysis. It's been around 40 years. And it's updated every 2 years. And it gives you the analysis. And it's kind of this almost unbelievable result in findings that says it's returned something like 35% net returns for 40 years if you had done every search fund. I'm not sure when people hear that, they realize how astonishing that is. Because if you think about 40 years compounded of 35%, that is Google, right? Some people go, well, you're buying these good, boring businesses, but that's not sexy. Well, 35% compounded for 40 years is beyond sexy, right? I'll remind people listening that people who have bought and invested in search funds for the last several decades, they're rich. How else to put it? They're rich. I'm coming to it late in the game, and things are changing, but let's pretend that those returns come down a little bit. They're still higher than venture capital. they're still higher than private equity. They're still higher than the stock market. And, you look at asset classes and you think about risk and reward. So on the upside, that's the reward. But you also say, oh my gosh, what are the bad years? Search has not really had down years. And there's a reason for that. Search is buying profitable companies. The entrepreneurship through acquisition, you're acquiring, the playbook says you're acquiring a $2 to $5 million EBITDA business that's growing in profitability for the last 3 years. So it's proven product market fit. It doesn't need a second round. Burn rate is not the question, right? And so you have the luxury, because you're hopefully growing this company, of being thoughtful and patient about when you need to sell it. And on the other side, venture, you asked me about venture. Today, venture funds, there are some venture funds that will be 25-year venture funds. That's how long it's going to take for liquidity. On the other side of search funds, of these acquisitions, is over $1 trillion of private equity money that's been raised that has a time bomb, has a clock ticking that they have to invest in. So our liquidity is waiting just on the other side if we can grow these companies appropriately. So for me, all those reasons said, I need to be spending my time in ETA. And so that's part of it, just at the asset allocation, at the return. But the other thing is, I'm doing it because it feels like venture 30 years ago. I love explaining and evangelizing and getting people excited about this, as I am. And I also love to think about how I can add value. We go back to, I said I added value in venture. Well, hopefully I can add value by taking some of the things I learned in venture and applying them to search. And where are we right now? At this moment, we are at the moment where AI is going to disrupt everything. I don't even think people fully get what's about to happen. I mean, maybe people in the venture world, of course, do, right? But Main Street America and the rest of the world, I'm not sure. And so what I'm really excited about, I mean, ETA has been amazing, as I just described. But what if we can take these 33, 34-year-olds coming out of these business schools who are already tech comfortable and tech savvy, and they can apply basic AI tools to these small businesses? Well, all of a sudden, they're competing in a different way against the other plumbing companies, and the returns could be quite astonishing. So I'm excited about thinking about how I can help bring that to the ecosystem with all my contacts in the tech world and the venture world. And so that can be a differentiation. I'm working on other things to bring value add. One of the things I love the most, and I'll stop talking, I realize I'm going on and on. One of the things I love the most about search funds and the ETA world is it reminds me of when I was doing venture, and it was a small group of venture funds and investors who all added value. And I really think it's hard for people to understand this until you've been to the Harvard Search Fund Conference or the Stanford. There's a mindset here that is almost academic, that I want to teach this generation of entrepreneurs. I want to coach them. I want to mentor them. I want to add value. And if you're not adding value, you're generally not asked to be at the table. And I take that very seriously. And I think it's, again, part of the magic of why this has worked so well, and I think will continue to work really well.
Perfect. Jon, now looking at this process that you show, that you explain, looking for the funds to look for the company in the first place, acquire that company, go through all the acquisition phase, and then running that company. So if we look at the identification phase, if you had to pick the top 3 type of companies out there to acquire, like what would be that type of company that you choose?
One of the professors at Harvard likes to say there's riches in the niches. And what that means is there's a broad set of companies that you can buy and improve and make money on and grow the value. And so the way we think about it is what kinds of companies, what are the criteria? And it's pretty broad. For example, in my first fund, we're going to have something like 200 in our portfolio, 200. With that, we'll have over 100 different industries represented. And so we're buying companies that are in fragmented industries, that are growing, that are about 2 to 5 in EBITDA, that don't have a lot of government regulation risk, that don't have a lot of customer concentration risk. And it's super broad. And that's what I like, because they're everywhere. They're from Florida to Washington. They're in Topeka and Peoria and Omaha, Oklahoma City, right? These companies exist. And so that's the opportunity for an entrepreneur who says, I don't need to be in San Francisco or Miami or Austin. These companies exist all over. And you're trying to take a company, in venture, you're kind of trying for perfection. You're trying to build it's called a unicorn, because there aren't very many of them. That's not the approach in our world. The approach in our world is take a good company and make it better. It's like Warren Buffett says, buy a really good company at a really fair price with good management, and you've got a winning formula. And that's what we're trying to do.
And if we look at maybe at the metrics, like what are those key metrics that you look for then when you try to identify the best target among all of them?
Yeah, you're trying to find a combination of a margin and a growth rate, sometimes a rule of 40. You're trying to find, again, what kind of earnings, what's the quality of earnings. So you're making sure, ideally, you're looking, we learned from the SaaS world, you want some kind of recurring revenue, right? You want to look at how is the owner deploying capital back into the company or not. And sometimes not, by the way, is the opportunity, because you could do that. So that's what you're looking for. You're looking for a type of size, you're looking for the customer concentration, and you're looking for the recurring revenue.
And in terms of size of the company, so you said small company, so we are talking about like a few millions in revenue or even
Not
less?
revenue, no, in profits, in EBITDA.
Okay, so you specifically
so it's 15 to $40 million in revenue, something like that.
Okay, clear. And in terms
so
of...
it is established. It is working.
Okay. So yeah, in terms of acquiring the company, like usually what's the ideal process? Like with the investors that they backed you at the beginning, you raise an additional fund to acquire that company, or maybe the company?
Yeah. So what you're doing is you're calling CEOs and you're saying, do you want to sell? Do you want to sell? And the numbers are something like, I'm going to get, over the couple years that I'm doing this, 70 interested sellers. But interested does not mean they're going to do it. They're just saying, yeah, tell me more. And then I'm going to get down to 3 actual letters of intent. And of the 3, only one out of 3 actually gets consummated into a sale. So it's a grind. It's a long process. But again, let me explain to answer your question. My 12 investors at that point get the first right of refusal to invest into the acquisition. So that's when they do the bigger investment. They may say, I like you as a searcher. I like the deal. I like the industry. I'm in. I'm going to do my first right of refusal pro rata and invest in this company with you running it. And so that same set of investors who's got to know me for the last year and a half, as I've done this search, are now going to be on my board and still continue to coach me through success as a CEO.
And in terms of investment, we are talking about 10, 30 millions of investment in that company.
Yeah, but we use a little leverage, usually both bank financing and seller financing. So the seller is motivated to stay in the game and make sure the transition is successful. That's very important. People buying companies without this playbook don't usually get that. That's hard. And this, we're cautious about using leverage. With those kinds of returns, some leverage makes a lot of sense. But generally speaking, we also want to be careful because we know there's a J curve. You buy a company and often the first year, as you're transitioning, you don't have this. You have more like this as you're changing things and getting to know the culture, and the culture is getting to know you. So you don't put too much debt on it, which, by the way, when private equity buys, they put more debt on it and they replace the CEO and they have a different playbook. But for this size of company, that's our playbook. So we put half debt, maybe half equity, and off we go.
And the CEO stays in place or is replaced?
No, the searcher becomes the CEO.
The searcher becomes the CEO. Okay.
But there's a transition plan. So you make sure that you don't pay out the full amount up front. You pay out some of it, but you also make sure there's something associated with continued growth and involvement.
Clear. And in terms of structure of the team, usually there's a big restructuring internally, or
no, you try and you hope that the team wants to stay in place just with the transition of the CEO. You're hopefully buying a company where you feel good about the team. Maybe there's a little bit of change. Maybe some people don't change, but it's not a wholesale change.
Okay, clear. And in terms of challenges that you see or main risk, like during this phase in terms of identification, what do you think are the biggest risks that
look, small businesses are messy. People don't always represent the truth. You come in and you've got to transition. People don't like change. Some people are going to leave. Some people are aging out, different motivations. I mean, for sure, expect the unexpected. You go in and you do your due diligence and you get your quality of earnings and you have experts look at the industry and expect the unexpected. That always happens. But thankfully, we're working with a group of people who have done this and been part of so many transitions. There's some pretty good pattern recognition so that when that unexpected happens, it's not panic time. It's, okay, now we need to do this, this, and this. Let's get this back on track. But if you're a sole individual trying to just go out and buy a business, that sounds really hard to me. I like this system because it has so many guardrails built in for the unexpected.
And clear. So in terms of examples of successful companies, like I know that most of them, they're still running, of course, but for sure there's going to be one that have been.
There is one. There is a Google, and it's fun. I was just listening to a podcast with Irv Grossbeck and people who were part of this first deal called Assurion. And I think it's probably, I don't know, even venture deals that have had this kind of return. It's extraordinary. And they were buying originally I think it was a car towing company and selling some side products around cellular back in the day. And it eventually morphed into the largest product guarantee, the extended warranty. They were really the leaders in, you buy an electronics device and would you like to extend the warranty? That's Assurion. And I mean, I don't even know if it's 50,000X or something. It's a great story, and there's a bunch of podcasts on it. And it really, the people, and what's cool for me about that is the people who invested in it and who found that company and who led that company. Most of them are still today teaching at the business schools, investing into the asset class, available for advice. And that's the power. I mean, that to me describes how much passion there is for people within this small little ecosystem for continuing and playing off their, that's how Silicon Valley used to be. Is you didn't have this great outcome and then go sit on the beach. You had a great outcome and you said, how can I do it again? How can I support others doing it? And that's very much what the search fund world is like. And that is, again, part of the reason for success, but also part of the reason why I love being involved. I learn so much from these people continuously. There's not a time where I'm with them that I don't think, okay, well, that's it. You've done some really interesting things. You're really smart. I mean, if you want great people on this podcast, you get those people who have lived in the trenches, who have done it time and time again. They're the heroes.
That's great. And do you have also some examples maybe of companies that had the kind of low operational cost and high potential in terms of automation? So really to drive kind of more.
Yeah, I mean, sure.
Away.
I think we're at this moment right now where people are really thinking about that. One of the things about AI is, for the first time in the history of the world, literally, if you can think it, you can basically create it right here on your desktop in minutes. So just think about all the categories that are going to be disrupted. Lawyers. Why am I paying a lawyer tens of thousands of dollars for a template document when I know right now? Or accountants, or. And so I think that the opportunity for increasing automation in almost any company. Now, maybe one of the areas that we invest in a lot are what I'll call guys in trucks. People that, until the robots take over, you're still going to need those guys going out to do a service call or what have you. That's not going to be as automated, but the customer service will be, right? The sales process will be, the HR will be, the accounting will be. And so you're taking a company. I mean, look, let me step back for 1 second. Italy, where you're from, has a negative birth rate. Japan has a negative birth rate. Demographics around the world are an issue for a lot of countries, as you know. And so in those countries, there are small businesses that literally have had great success that will just have to close their door. There will be no one to buy them. The kids don't want to take over anymore. So automation is going to have to be a solution for some of those businesses, right? Because there are just going to be less people to do it. And so for me, this conversation, I'm thinking about this almost every day. How can we take a small business and take the processes and make them more efficient through technology?
Because of course, what you're saying that, yeah, it could be ideal to target one of these areas that has, high potential of automation, but at the same time, there's probably also a high risk that the entire specific role of that company is replaced by automation itself.
Yeah, but
so either you lead it or...
Yeah, people are already thinking about this, and venture people are thinking about it, and private equity people are thinking. It's going to happen quite fast, I think. I think it's going to be really interesting. And I think, whenever there's change means there's opportunity. And that's why right now is such an interesting time.
The moment that you are running that company, what do you think are the main areas that, a person like the new entrepreneur should target first to drive improvements?
Well, the good news is I don't have to do that. But the people who are doing it, that's what they've been studying in business school. That's what the people around the table are helping them with. So by the time they come in, they've literally had classes on how do you hire a board? How do you fire people? What do you do in your first 100 days? They have had seminars and classes and case studies on exactly all the areas it takes to run a company. Now, it's different in a practical sense when you're in the company, but you've actually been learning this throughout your business school career and beyond. And the people who invest in you have ongoing courses, and there are great books on this, and there are great podcasts, and the blah, blah, blah. So and the answer to your question specifically is it's not one thing. You come in, you're running a business. As you know, it's a lot of things. And it's not even just, I got to make sure our accounting function is great. I got to make sure, our sales process, I got to talk to my customers. It's also, how do I come in and create the culture that allows me as a leader to be embedded and leading this organization to success. That's the entrepreneurial part. That's what this whole journey is about. But it's 100 things, not one thing.
Of course. And if we look, at how AI, jumping back to what you were saying, when it comes to AI, how is impacting the asset class itself? Do you think it's gonna increase the returns through this, or it's gonna be a shaking situation?
Yeah, it's a great question. I don't know is the answer. I do think that just as a natural rollout of AI, it's going to happen at the big companies first and trickle down to the smaller companies. And if we can learn from what's happening here and apply it here before others, it sure seems like we have a really interesting opportunity. I mean, again, the returns have been great. Are they going to get better? That seems like an outlandish statement. But if they do, watch out. And to be clear, more money is figuring this out. So more money is coming into what I'm going to call lower market private equity, which is what this is. But there are only so many business schools teaching this, and there are only so many experienced investors around the table applying this system. As long as we stick to what we do, which is investing in this system with these great CEOs, I think we'll do well, and I think the asset class.
Okay. Jon, a few last questions before concluding. Sure. Share with us maybe your piece of advice for an entrepreneur who wants to go out there and buy a company.
Well, first of all, really, really ask yourself if you want to do this. You know, what people don't realize, it's not hard to buy a small business. It's hard buying a small business and successfully running it and getting an outcome. Don't buy yourself a job if that's what you're doing this for. Do it because you are motivated as an entrepreneur. And then if this is what you think you want to do, after you have really done your homework, after you've read the books, after you've gone to the conference, after you've spoken to others who have done this. I think some people do this for the wrong reason, and they're not going to be successful, generally speaking. So that's number one. Like, really be clear this is what you want to do. Number two, if you do want to do it, there's an ever increasing amount of great resources available for people who want to do it. And I personally believe the more that you can replicate this system or playbook, the better your chances for success are going to be. And then think about, are you willing to do it in a place that's not obvious? Are you willing to do it in a city that maybe isn't sexy to live in? Are you willing to do it in an industry that at a cocktail party, nobody wants to hear about? That's what you have to ask yourself. Well, again, why are you doing it? And if all those things still say yes to you, then go for it. Because it's the silver tsunami. It's the greatest transition of wealth in the history of the world. But I'm just telling you, I don't think enough people really ask themselves the hard questions. And that's the first thing I would be doing if I was going to really say, this is what I want to do.
And now looking at your background and your experience in the past, so more of a personal question here. Tell us what you would have done differently.
Well, that's a question. I've made a lot of mistakes. I've failed a lot. I've fallen down a lot, but I don't live with regret that way. I just try and learn from it. I mean, I've been very lucky. I feel like I've had a front row seat at the rollout of some of the greatest innovation and technological change in the history of the world. So all I do is try and guide with the principles of learning a little bit more every day, staying curious and hungry, being around really exciting, inspiring people, and trying to give back. And if I can do all those things, the rest takes care of itself.
And one last question here. Looking at the accelerating pace of change that is happening in the world during technological development, what is your main concern about the digital future, but also what excites you most about it?
We don't know what we don't know. And it's happening faster. Someone said it the other day by saying a century and a decade. And I think the next 10 years is going to be a wild ride. So either you're going to embrace it or you're going to shield yourself from it. I'm going to embrace it and try and bring good where possible. And, you know, I'm a believer. I'm an optimist. I'm hopeful. Like anything in the history of the world, there's always a trade-off. There's always good. There's always bad. There's always, you know, for every action, there's an opposite equal reaction. We'll see. But I will say humans, I'm not sure are yet ready to manage the kind of accelerated change that you're talking about. So I hope we figure out not how to be divided, but how to come together and realize there's never been a more important time for that. And, you know, just to bring it back to small businesses, I honestly believe that what made America great for the last 50 years is that people had hope that if they worked hard and followed the rules, they could get ahead. And I think that's what search funds are about. And I think if we create a society where people are given that chance, then they'll feel good. They'll treat others kindly. The society will prosper and we'll survive all of this. So that's my hope and that's my belief.
Jon, it's been a really great conversation. Thanks for sharing your insights. And definitely it's going to be another occasion to speak more.
Thank you so much. I really enjoyed it.
Thank you. Bye-bye.
Bye-bye.
Thank you for watching this incredible interview. Leave us your comment with what you think about this episode, what you would like to discuss in the future, or any guest suggestion. And remember, you can follow us on social media. You will find in the description the links. Thank you again for your time, and I see you to the next episode.